Hello and welcome back to Swing Trading Masterclass by Wealthy Education. In this video, we're taking a look at flags and pennants. Now, these are two very popular patterns that you will run into when trading. They can occur on any time frame. They are more potent on the higher time frames, which is the case with most patterns. But what's interesting about them is they have a run. Initially, there's a run, and then there's some type of consolidation, and then there's another run. So with a flag, you would have a run higher or lower because there is a bullish and a bearish version. So in the bullish version, you would be in an uptrend, and then you kind of pull back and you form a channel. Conflicting support and resistance, and there you go. You can see why it might be called a flag. In a bearish flag, it's the exact same thing. We're in a downtrend, and then we kind of pull back a little bit and form a channel. Now, the thing about flags is that you take the measurement of the pole of the flag. So let's just say it's $30. And on a break of the top of the channel, you're looking for a move of $30. You can just put your stop loss on the other side of the flag itself. And that protects you from losses because that means that there is quite a bit of order flow there. So if it gets chewed through, you know something's changed. Flags are loved by traders because they're so easy to spot and they happen. A lot of people will be paying attention to how they form. So that's a flag. So what's the difference between a flag and a pennant? Well, basically the shape of the consolidation. So in a pennant, it might be something more like this. Basically, it's a triangle. So your consolidation is just that. You're in an uptrend, and this one, you consolidate a bit, and then you take off. You're in a downtrend in this one, you consolidate into a triangle, and then you break down. Same rules for measurement. So if this is a $30 pole, when I break out, you're looking for 30. Break down, you're looking for 30. So let's take a look at some real life examples here. Here is a triangle. Which you can see. And, we learned about that in the last video. But notice how we ran higher right before it. There's a pole, so that makes this a pennant. And you can see that we got that target without too many issues. This is just simply a surge higher, people kind of consolidating, maybe taking gains, people deciding whether or not they want to get involved. And then when we break out to the upside, it's a confirmation of people get involved in the British pound on the hourly chart. This is Ethereum on the daily chart. You can make an argument for a bit of a triangle here. With a move lower in the pole. Now this one was a little trickier because you did get your target down here, but you had to wait a while. That's the thing. There's no guaranteeing that you're going to get there right away, but you can see you would have never come close to hitting your stop loss here. So Litecoin on the daily chart formed a little bit of a channel here, which was preceded by a move higher. And you can see clearly we hit that. There was really no concerns about that at all. And over here in Citigroup, a little bit of a channel here, but it was preceded by a grind lower, and there's your pole. Pole most certainly got hit and more. That's not uncommon. So that's the great thing about this pattern. It's kind of obvious, you're going with the trend. This isn't a reversal pattern. This is a move. The markets take a break and then they continue. So it's great for trend trading too. A lot of trend traders really like this pattern.